All right. All right. Welcome again to another Great Money Monday. My name is Rosalind Brown, and I'm your wealth guide. And as always, we come to you every single Monday with actionable insights to guide you on your financial independence journey. That looks so different for so many people. And there are so many factors along the journey that we might not even be familiar with. And so it's always key for us to have options, for us to know what else is out there, for us to be able to really move and vote with our wallets. And so today we have James Brewer. He is the CEO of Envision Wealth Planning in Chicago, Illinois. Envision has been recognized as one of the 20 best financial advisors in Chicago by expertise for their part for the past 4 years. He and his firm were recently highlighted in the New York Times article, "If you live to 100, you'll need more than money." That's key. He is a Forbes.com personal finance contributor and co-author of Biases in Retirement and Wealth Planning. And ladies, I don't have to even explain that to you. Everybody probably we know. Financial Behavior, published by Oxford University Press. He has been quoted in the Wall Street Journal, US News, Next Avenue, CNBC, and Yahoo Finance. He was a speaker at the Financial Planning Association Conference and keynote speaker for Financial Stress in America in 2019. His professional designations include Certified Divorce Financial Analyst. We have one of those already. So ladies, we know how key that is. College funding and student loan advisor, and the gold standard for financial planning, the Certified Financial Planner, CFP designation. He holds a master's in science and an MBA from the MIT Sloan School of Management. So without further ado, I want to welcome our speaker today, Mr. James Brewer. Please give us those great insights on how we can really take our wallets and our investments and make them even more powerful in our beliefs.
Well, thank you so much for having me. Just want to check that you can't see my screen. All right, then let's do this thing. So, what I'd like to start with is an article that I actually wrote for Forbes, and it's called "Are You Unknowingly Invested in Private Prisons?" But today's caption, I thought, was, well, what's actually inside those returns? People have been telling me that the returns these days look pretty good when it comes to the stock market, or even what's going on in a workplace plan, but do they actually know what's inside of those? And they might be surprised at what they find. So let's get on with our aligning your values with your investment strategy. And one of the things that we say that we do at Envision Wealth Planning is help people make smarter money moves that are aligned with their values. I mean, isn't money really just fuel for the rest of the things that we want to do in our life? So we've got a little agenda here today. I want to talk about needs and goals-based investing, my investment process. I want to talk about causes or values and what those might be versus investment benchmarks. Then package versus custom portfolio construction, and I'm going to call it my envisioneering portfolios. So one of the things I like to tell people is, well, do you know your SAT score? And in this case, the SAT score would mean how much you need to save, at what asset allocation. You might use the word investment return. I'm using asset allocation over what time. So the SAT is savings, asset, and time. And it takes kind of the thought process of what is your risk need tolerance as opposed to what is your risk tolerance, the thing that you might already have educated or just what feels good about risk. So this quick example just shows, well, what if you save $500 per month and getting a 7.2% return over a 32-year time horizon? And let's believe that for this lady who's joyous, that's going to hit what she wants for her retirement. Won't get too deep into retirement tonight. Just want to stay on the investing side. But that's how we inform what allocation you need. And in the process, I also consider things like taxes. So if you're doing a 401k IRA versus something that is in a brokerage account that has no tax advantage, then you would want to look potentially at investing you differently. What are your values? Things like racial justice, gender equity, etc. Location can be depending upon what investment platform that you find yourself on, or inside of what type of vehicle. Say it's an annuity, a variable annuity, as opposed to just simply a brokerage account. And boom, out of that comes your portfolio. And if you haven't seen this before, this will give you a little bit of idea. Something called modern portfolio theory, this kind of boomerang-looking thing, basically says that you could be 100% in bonds, or you could be, say, a third in stocks and 2/3 in bonds, and moving all the way out to 100% in stocks. So that's kind of a different, more strategic asset allocation thought process. And I just bring that up to say what I'm going to show you tonight is going to be something inside of what is structurally sound from an investment advisor's, or let's call it this investment advisor's perspective. So just kind of showing you the relationships that my firm has. You might have your own advisor, they've got their own. Envision is a registered investment advisor, so that gives us the ability to potentially look at lots of different types of investments that maybe some people couldn't. So I'm going to show you some things that likely will be unique tonight. And then in this box, we're going to talk about the 712 strategies, a firm called Addisina Social Capital, Green Century Funds, iShares, Envision, of course, and then a firm called Open Invest that does something called direct indexing, or another way for you to kind of pick stocks inside of things. So I created this slide to give you an idea of what I'm going to call some Envision prefabricated. So these are things that you don't get to customize. We're going to look at Green Century Balance Mutual Fund, and that is for mutual fund. If you were concerned about something else, I'm going to call this my Justice series, where we're blending the Addisina Justice exchange traded fund with an iShares advanced ESG bond, the 712 series, but we're going to use this ESG model. And if you're wondering what ESG is, environmental, social, and governance, I probably should have covered that earlier. I was maybe blew past that. You could also say that ESG is another way of saying socially responsible investing. Some people might say ethical investing. Another way to say it is cause-based investing. There's lots of different terms for this, which is more, I've gone to something more generic even than said values integrated portfolios. And then finally, we're going to talk about things where you can actually specify the specific things that you want to invest in or not invest in. So let's start off with screening. So this idea of screening has this idea that potentially you can screen out. And historically, most of it started with screening out things as opposed to screening in things. But I like you to think of this, like, well, if you're going to take something out, what are you going to replace it with? And maybe replacing it is just simply inflating something else or adding more of it. It's the same stuff, just more of it as opposed to something else. So you're not necessarily losing out, what some people might think that that's what's going on. So I'm going to start off with the Green Century Funds. Green Century Funds actually does something interesting, and let's call this advocacy. So besides just doing the investing side of things, it does some advocacy, and I'm trying to turn on something here, and let's see if I can get my spotlight tool to work. So we're looking at shareholder advocacy. Hopefully you can see my mouse moving here. And then they've got their investment strategies, and they talk about their advocacy here as well. So they start off with their own process. They're really looking at things that are more in the green space and getting out of fossil fuels, it says here, taking some of their materials and cut them up. So that's really what they're focused in. And instead of saying, I think, overall E, S, and G, they're really environmental. And then now let's look at Addisina Social Capital. You'll see on their list of things is racial justice, gender justice, economic justice, climate adjustment, and they're calling it movement aligned. So, some of this cause idea that I was kind of forwarding before. So, this is, I would say, this looks like it's more the E, S, and G, although they feel there that it's about social justice, and that's what they call it, that it's social justice and includes all of these elements. And then iShares has this bond that it's called this Advanced ESG is the one I'm showing you. And it screens out things for, say, adult entertainment, alcohol, gambling, tobacco, etc. And for-profit prisons. One of the things that I target often, for-profit prisons. And they have their own process as well in terms of how they do it. And then let's look at Open Invest, where it takes more of a customized approach to things. So not only do they have, divestment from various greenhouse gas emissions, etc. They've got something around Catholic and halal values, as well as private prisons and a lot of other things, but you can actually customize it in their case, and you can choose. It's not just take the package. So now let's go to ESG performance, because usually people say, well, what about returns? Well, can you have your returns and your values too? But I'm going to actually question and say, what is the benchmark? Like, what's the benchmark anyway? Let's start off with Green Century Mutual Funds. In the smaller print, it's not quite small, in the smaller print, it says that they're using a weighting of the S&P 1500. Well, you probably have only heard of the S&P 500. Well, they apparently added 1,000 more companies. So this still is the largest United States 1,500 companies. The universe of investable companies is actually bigger than the 500. It's popular to hear about that. And then they've got this thing of Bank of America, Merrill Lynch, 1 to 2 10-year U.S. corporate and governance index. That's what they're using for the bonds. So 60% is in stocks, 40% is in bonds. That's usually called a moderate portfolio. And let me help your eye. Let's go over here and say that since inception of this, or maybe we'll just start off with the last 10 years, one of these made 8.94%, the other made 8.95%. I'll point out that both of these are the same fund. It's just there's what's called share classes. So one was the institutional share class, one was the individual investor share class. They've made some tweaks on what that looks like now, and you can get in at a smaller number today, and then they show you what the returns are against the benchmark. Now, most of the time that I talk to people, they don't generally tell me that they got 9% roughly over the last 10 years. So this one mutual fund with, again, it's 60% stock, it's 40% bond. You could get more stock if you want, but over 10 years got 9%. And sometimes I have people who say, well, what the heck am I invested in? Like, what is this environmental thing? Well, you might not have thought of Apple or Microsoft or Google, Alphabet's now what they're called, or MasterCard, as being some of the companies that would actually fall in and be part of that investable universe. I once had somebody who thought they were kind of being nonprofits as opposed to profit-making or profit-seeking companies. The question just is, what are they doing along the way to pursue those returns? Now I'm going to enter the Adesina. They actually compare themselves to the FTSE, that's what they call it, but it's the Financial Times Stock Exchange. It's the Russell Investments Bar, which is a financial organization that specializes in indices. So it's looking at potentially 8,000 stocks. 8,000 stocks. And here are their returns. So far this year, it's been 9.64. You'll find that this hasn't been a long, or this hasn't been out for a very long time period, but a lot of people might like the returns that they're having so far, and all those racial justice, gender, climate, economic, and movement aligned. You'll see it's in Visa and NVIDIA, and Adobe. A lot of us are probably using Adobe. I used some of Adobe in preparing for tonight's presentation. So that's a quick look at Adesina's social capital, which is, interestingly enough, there's a black woman who started it, and it uses a chief financial officer, not a chief financial officer, sorry, a CFA, Chartered Financial Analyst, who's also an African-American male, who helped to develop how the investing methodology from the universe. So I think it's important that you understand who's behind it. Oh yeah, by the way, Green Century is run by a woman. Now, there's something called a 712 index. It's a way to bring together 7 different core asset classes, large U.S. stocks, mid-cap, small, as well with some other asset classes. Won't get into its particulars right now, but to tell you that's a strategy. Now, inside of this strategy that I'm going to show the returns, it has companies like this. Now, inside of that, each one of those is roughly about 8.33% of the total of all that 12. So some of the companies on here might be familiar looking to you. And now let me get to the green here. They got 21.62. Now what's interesting is if you look at this actually just started last year. I was able to talk with the person who developed the overall strategy, and I brought up, hey, had you ever considered doing an ESG version of it? He said, no, I hadn't, and he came up with some ideas. I put some more of my thoughts in his ideas. But what's cool is over 20 years, so we haven't necessarily looked at 20-year time periods, but over 20 years, you could see that almost all of these were somewhere around 7%. One was a little higher than the others. One can't ever tell, like what's that's higher than this. You might have heard of Fidelity. You might have heard of Vanguard. You know, the idea of being able to predict what the future is going to hold is why we say that past performance is no indication of the future. But I was really excited to see that the number one performing one last year was the ESG version. Look forward to seeing its next 9 years of returns. So, I'm going to take you into the open invest. That is the customized way of doing things. But I'm going to take you in by way of showing you some hypotheticals that I created using Morningstar, which is a research tool that advisors use, and to show you that when I compared it against its benchmark, in this case it was a Vanguard moderate growth fund, but we're the red line. It's better, and it basically uses a couple of indices that we will explain to you. Oh, I think I'm missing a slide. Oh, well, I better explain it then. So, I took 80% of the Russell 3000, that's the largest 3,000 companies, with 20% of companies in the world, which is called MSCI ACWI in the world, let's say. It's about another 3,500 companies roughly, and created this. And then here's one where we didn't add any bonds. So the one before was more the equivalent to, well, what if we added some bonds like that Green Century that I showed you before? And this one went more to, what if we just went all stock? I added a fee in there, and after even adding the fee, it got close to 9% since 2008. So now let's look more into Open Invest. So within you select your benchmark, and then you choose your causes. Now I see where I moved that slide. So now you can see it on the screen as opposed to me just using my voice. And here's some interesting parts. Hopefully you can see this. So I created one for tonight. I use it in other places. So I'm going to lovingly call it the Black Woman's Portfolio. Hopefully that's not offensive to anyone. I decided that we would invest in racial justice, divest from private prisons, and invest in women leaders. That they call it women leaders. I put gender equity on the thing. So the first one, let's just look at how they do it. So they look and said, well, hey, of the benchmark that I created, that about 24% of the companies actually were profiting from the prison industrial complex, which is kind of bigger than just private prisons alone. But then they also said, but let's look at companies that might actually hire the formerly incarcerated. So you'll see that it creates 3 portfolios. And as we do more in the value, this number increases. But in all cases, we got rid of the ones that are the violators. And you're going to see that in this case, Facebook made the cut, but Microsoft did not. Investing in racial justice. Some companies, 9%, were known for perpetuating racial injustice. So we got rid of those. And the ones committed went from 22.7 to 40.3. And we see Abbott Labs as a positive, but unfortunately Google is not. In fact, a quick side story, one of the reasons that I actually got into the business in the first place was I was unhappy that there were companies I could tell who weren't hiring me, and I believed it was for a certain reason, and said I didn't want to support companies who didn't want to support me. And then finally, let's look at investing in women leaders. This said that about 16% were lagging in women in leadership. And instead here we went from 33.7 companies promoting women leadership all the way up to 58%. And United Health Group gets to be the poster child for being good in this particular case. So now let's look at the Constituents and how their brand of screening works. So they take all of those companies from the Russell 3000 and that MSCI, and then they put it through their screens, and you'll see that some say neutral, some say negative, some say 2 positives. So a negative with 2 positives means that you're out. Neutrals, while not making you positive, keep you in. So positive, neutral, neutral, now you see it, and they go through all of the companies. But in a cool way, I think they kind of tell you which category that they found in their research that said, this company didn't do so well. Now, you might also figure out that if you only went for women leaders, then you would have had these two companies stay in, or Apple's two different shares would have stayed in. But because you put in 3, or in this case, I put in 3, that's what happened. If you want to, you can click a button and get a complete download of all the companies. You may also say, you know what, you said the company was bad, but I feel as though that I like them. So I think I really want some Google. I want to override what this does, and you can decide you want to add that in yourself. Or you might see a company that you think's bad and it's on the list, and then you can take it out. That's one of the benefits of this direct indexing. Now, unfortunately, with certain things that are investing, as you get more accustomed, typically the price of entry increases or something about it. So all of these may not be available to everyone just because of the size of the investment, but I wanted to show many choices tonight of how you might get there anyway. And then now let's talk about my cost-adjusted portfolio returns. So we talked about benchmarks before. So the benchmark returns at the top, a little grayed out, but hopefully you can still see it. But I'll point out some of the years. So in 2016, it was 14.42 against the 14.69, the 30.93, and interestingly here in 2017, that by being more into the values, because that's what this OI, or Open Invest Portfolio 3, means, that they were trying to do more in your value, that you actually got the same as you did with less, maybe a scant bit different. Now, I know that we're investing or comparing ourselves against the benchmark. Benchmarks have no fees, so it's not really a fair comparison, because if you were going to do a benchmark, it would cost something in order to get there. And this, we've actually put in the fees, at least the fees from Open Invest side, to be able to do this. But in talking to people over the last few years, a 30.93%, 36, 30.89 for the year-ending value. I don't know many people who've done that. Now, in order to do this one has no bonds. It has all stock. So I'm just pointing that out. It's all stock. If you're willing to deal with dips like this, or sometimes there's more dips felt than what are even shown on the screen. So if you could handle that dip, then you could have come back. But I don't know that everybody wants to do this, but I'm just highlighting it. And so far, which I ran this as of, I think, Friday's close, it's about 12 and a half. Now, depending upon which causes you choose, your results will be different than this. So it's the causes that are important to you. So I picked 3 causes tonight. Those may not be the causes for you. You may want to add climate in, or you may want to add something that they have for disability inclusion, or alcohol, or gambling. So there's different ways that you can screen, but we want you, if you are interested in this, to fine-tune the portfolio to get what you want. But as I started with, if you are using this for your retirement, for a down payment on something in the future, to start a business, or whatever things where we're saving up money, investing that money to hit a certain dollar amount in the future, then I would suggest that you don't go for this all stock if that doesn't make sense for that goal. And sometimes less is more in terms of goals, especially when they have shorter time frames, because the regret would be bigger if you tried the big risk, and then that's when you experienced this only when you were thinking, hey, I was going to get this amount, and the next thing you know, it's down here. But if you do have the risk tolerance to take this, then this just at least gives you a pretty good idea that, as people may have said, well, geez, aren't you going to lose out on a return? Well, I've shown you about 3 different, possibly 4 different ways to benchmark, where we had the S&P 1500, we had this World FTSE, we've had the MSCI ACWI, and we've had the Russell 3000. So it's important to know how the benchmarks, because you're going to end up seeing different results just from the benchmarks alone. But I hope I can encourage you, indeed, to decide that you want to incorporate your values into your investments as you build your own house and make smarter money moves.
I think this was really great stuff, because oftentimes we just don't think about it. And sometimes we're chasing returns, but not aware that, goodness gracious, in the effort to chase returns, you're also supporting organizations that don't align with your values. In the same way, especially more so over the past few years, we've been very cognizant of brands and companies that don't align with us, and we won't shop at that store, we won't order from their online store, we won't use their services and so forth. We should be doing the same thing with our investments that we're using to fund our retirement, fund our overall living expenses and so forth. And I don't know if everyone is aware that it's possible without giving up those gains that are so important as well. So I want to thank you for sharing that information. Now, I do have a couple of questions. So we got one question. What are some of the typical fees for the funds that you talked about? So I know fees are always a big deal, and you talked a little bit about the benchmarks, and of course, returns and fees are always a big deal to people. What are some things in terms of what would be reasonable?
You know, fees alone is probably a really long conversation, so let me try to give a short version. So the Green Century is a mutual fund, so fees of some sort are already baked into the mutual fund. If you were to work with a financial advisor who would be familiar with things like this, I would believe they're going to charge you somewhere between 1 to 1.5%, but they may charge you more. I would be more concerned about making sure that you find an advisor who's familiar, who's knowledgeable about the space. If you don't, then you probably are overpaying, because you want someone that can explain to you a few of the things that I explained tonight. Because if you are focused at your end game and saying, after taxes and after fees, I need, going to the first slide with this, savings, asset allocation, and time, that after I net all of those things, I get my 7.9%. If that meant that you paid an advisor, let's say 1.5%, but they were able to help reduce your volatility from the way that they're investing your money, if they were able to keep you calm through markets, so you actually received or realized those returns, then that is, to me, worth the money, because it's what you got in the end. Much of the conversation around fees is making the assumption that if there were no advisor at all, then I would have made more money. I think it's not always easy to find a truly knowledgeable advisor. I believe Rosalind's program of trying to expose you to more people will help you do a better job of that. So I just know that there aren't that many advisors that are really steeped in the knowledge. So then so the harder challenge is, what am I paying for? But if you're buying certain mutual funds, they have a quote unquote sales load baked into them. And is that advisor really knowledgeable, or are they just getting paid for something to be a facilitator of the transaction rather than bringing advice to the table? So it's not such an easy thing to evaluate these, but those are a few thoughts that I have.
Now, we do have another question that talks about the minimum investment. And so I think sometimes people think this is something that's a lot more fancy or sophisticated. So you have to have a larger minimum investment in order to get started. Is this something that if you have $500, $1,000, whatever that number might be, that they could get started and have some of these funds that you talked about?
So the Green Century, I believe their minimum for an IRA is $1,000. An other account, I believe, is $2,500. It's on their website. I don't know if I cut and pasted that into that earlier slide. Many of the others are exchange-traded funds, so depending upon what they're trading at would be what you'd have to pay. If you're going to use an advisor, they usually are going to have some type of minimum dollar amount. So that's going to vary. I have a unique system. I'm not trying to make this a plug, but I'll just explain. So we help people through providing financial planning guidance. When we help people with financial planning guidance, we facilitate transactions of around $10,000. If we can't help you, so I have some of my clients who are using Green Century because it just made more sense for all parties involved that they would use Green Century. If you're going to use, say, the Open Invest more complex solution, possibly you could get in for $25,000, but let's believe that $100,000 amount gives you more flexibility to do more things. There's just a practical side of when you're trying to get a bunch of companies into your portfolio. Each one of them has a cost. So already, we're not each buying a share, we're getting a fractional share of that stock. So there's just a practical lower limit for somebody investing too.
I think that makes sense, but at least it says if you have an IRA and you want to reallocate what you have, you can get started on the lower end. And definitely if you have more, and a number of the companies that you listed are the same things that are in the mutual funds that they're probably invested in today. So there wouldn't be a huge kind of shuffle in what they're used to. None of the names that you're like, goodness, I've never heard of those. So that's a good one. But one thing someone said is from the screening perspective. So are there additional screens? You talked about if they have women in leadership, if they're investing in private prisons, and race equity. What are some of the other criteria that people can maybe switch on to say, I don't want this, this, or this as well?
Let's see, I'm trying to do something off the top of my head. Reducing greenhouse gas emissions, defunding pipelines on indigenous lands, gambling, alcohol, LGBTQ, it's a screen in, halal, Catholic values are some that immediately come to mind. That's in the Open Invest. The others may have their own way of doing screening. Some it's firearms versus, say, mass destruction weapons, being fossil free. So depending upon what you want, there might be a company that is best, or you might find it makes sense to blend a Addicina with a Green Century because you're trying to do more in the green world. So some of the companies do advocacy, and Green Century is one of them. So when you use them, they're also doing advocating in the field. Some companies, they don't do any advocating. They just simply do the screening and stay out of the advocating, or we could call it protest. But in this case, it's using protest with the share of the stock and using that as leverage. So you can look at different companies and assess whether or not their screen matches what you're looking to screen in or screen out. But just make sure that you're asking those types of questions. Usually they're going to give you the information. Often I find the challenge with some companies, because there's a lot in the space, I just decided not to give you everything and just give you a sampling, that they will hype the advocacy side, I believe, more in their screening and less so on their returns. So I think it's important to me that you get a blend. And even in the one slide where I showed lots of names, those lots of names came out of the fact that we were trying to fit lots of slots, because there were 12 different slots to be filled, and whether or not those companies are quite as purist in their approach. So one of the challenges becomes is some might be more pure. So if you check out my Forbes article, I wrote one on sustainability and the one that I wrote on private prisons, and I gave you some of the names where you can actually do your own screening. They've got some screening of some funds as well there. So that can broaden your understanding of what's out there.
Now, you also mentioned a number of benchmarks, but there were a few different ones. Is there one benchmark over another that people should be focused on as they're benchmarking the funds that they're getting? I know sometimes people present one thing and you're like, well, what about versus this? Is there one benchmark that would be better than another? I know you talked about the S&P 1500, or should it be 500 or FTSE? Which one should probably be more of the gold standard?
Man, I don't think there's a gold standard, but I like the concept of gold standard. Okay, first I'm going to say the S&P 500 is not the Index or Brewer. The Dow Jones isn't either. It's just that those, for some reason, became popular. So there are many different ways. So let's say that in that 712 example, that part of one of them was you bringing in small company stocks, or smaller stocks, but they're stocks that are investable companies. They're not like the corner store that you can't invest in. So there's research that shows why it's good to invest in small companies. Not all your money in small companies, and there's small companies internationally as there are, in emerging markets. So, but there's a risk and return profile that changes. So the conversation of what benchmarks really has to do with how you are going to go about putting together your mix. That was the A in allocation, the asset allocation, how you're going to put your mix. So there's different ways to get to the mix. What the benchmark can do is help you with your own expectation of what I should be comparing this to. Like, you shouldn't compare returns of small companies to the returns of big companies. Actually, what you should expect is that the return for small companies should be higher than the stock of large companies, which is not what most people might necessarily think. Like, well, no, should the big company? No, the bigger you are, the safer, quote unquote, you theoretically are becoming. And the riskier company is the smaller company. So the way to get compensated, or an investor should believe they're going to get compensated for the risk of the small company, is that they're going to give you more return. So, the comparison of the benchmarks really has to do more with the decision on how you're going to approach investing, and then what types of investments you're going to fit in those. So that's really a more advanced conversation. So there's not like a snapshot of do this one and forget about the others, because if you're going to have bonds, and nearly almost all investors have bonds, especially those who are in 401k plans, it doesn't make sense to compare an investment that has bonds to all the S&P 500. You have to add the bonds in, which is, with the Green Century example, did have the 40% bonds. So that's why having a blended benchmark is important. when that is what you're seeking from return and your up and down risk or volatility.
Now, one question about, do you work with other advisors? So someone, I guess they love their current advisor and they're saying, well, maybe I want to incorporate this too, but their advisor either is not having the conversation or not as well versed. Do you partner, or can they have maybe you to take on a portion and then another advisor to take on another portion?
That's the latter is probably the easiest. If they happen to be on the Charles Schwab platform, which I am, then that would probably facilitate that happening. Their advisor may or may not have access to all of the tools. For example, be able to use Open Invest. So depending upon what platform you're affiliated with, all of the options that I showed tonight may or may not be available. I know I spoke to one person and they only had one fund on their platform that would qualify as being an ESG, which that still doesn't mean that's the right one for you. Like, it could be that the one they have might be the right one for you, but often more choice is good to hone in on what you want. I guess the working with makes it a bit challenging, but there might be a way to figure out something through, a investment planning fee of sort that is a short engagement that would allow me to help them as long as you wanted to stay on that platform.
I think that's good. Now, one other person, one question they asked about doing it themselves. So is this something that they can screen themselves or find these funds themselves? I know we have a lot of self-taught or self-managed people. How likely is it for them to either be successful, or how time consuming is it in order for them to kind of self-serve in this space?
There are resources. If you look at my 2 articles that I wrote on Forbes, I talk about some of the screening resources for you to find to be able to do that. Some platforms won't allow quote unquote retail investors to access their tools. They were intended for investment advisors. So that may preclude you from being able to access some of them. The Green Century you could get to yourself. Potentially you could put together some of the exchange traded fund stuff that I quickly showed. But I think Open Invest only works with registered investment advisors or investment advisor representative firms. So there are ways to try to use, some of the other mutual funds or exchange traded funds out there to try to recreate some of what I talked about. But again, just be wary of some of the benchmark questions and, to figuring out how you want to create your own asset allocation without using the tools that are available to advisors. All advisors don't have them, but there are some tools that are specifically built for us.
I think this is huge. I think we got all the questions, but at the end of the day, we really are becoming more conscious about what goes into our body, where our money goes, what we invest in, who we do business with. And knowing that kind of information. When we talk about, I don't want to shop here anymore, but yet all of your 401k assets go to support that company. Or if you say, goodness gracious, I don't believe they treat people or they treat their employees in this manner, but yet and still you continue to invest with them. I think it's just key to know. And sometimes we're just sitting there and we just don't know. But once you know a little bit more, then you can take that power back and really be in charge, especially talk so much about the private prisons. And we know so much about the school to prison pipeline. And in reality, if we are financially contributing to that, we are part of the problem as well. And so if there's something that we can do in order to really vote with our money and protest with our money and really control these organizations that are being funded by us, we can take back some of that power and take away the power to those organizations that we just simply don't align with morally. And so I think this is a great strategy. And one great thing is you don't have to give up returns. And statistics even show more diverse companies, more forward-thinking companies, they typically do better financially. And so with that understanding, it also shows that you could still get some pretty decent returns, even taking into account these things. So you don't have to give up return to be conscious. And I often hear people, they're like, well, goodness, we need to invest in this, and this. Well, not necessarily, in order to get to those same returns that you're looking at. So I like that the presentation really talked about where you need to be. I am anti staying on trend. We are looking at things that are long-term, that are sustainable. So you don't always have to pivot in terms of your strategy to chase the next big thing. And so if there are any more questions, feel free to drop those. James, let us know if you have any closing remarks.
Well, one of the things, maybe I'll say two things. So the first goes a little bit to the question on doing it yourself. So be wary of investment or screening tools that screen for the moment as well. So what I mean is some mutual funds or exchange traded funds have in their documents prospectus that says what they can and cannot invest in. So I actually dropped a firm because they would not tell me they would not for sure be in private prisons. So when they said that, I said, then I'm out. Although that at the time I asked, they weren't in, because at any point they could be in, because that wasn't a screen for them. And I also developed an acronym that I think might be helpful. So just doing it in closing, and it's called VISA, not the Visa, your financial card, but VISA, meaning vote, invest, spend, and advocate. Often we do well on the vote. Some of us do the advocate by protesting, walking, carrying a sign, but Monday through Friday, what you're investing in, which could be a 401k, which is potentially a reason that you want to move that into an IRA where you have more control of what you're investing in. But if you use a tool like an Open Invest, or even if you look at the top 10 holdings, some of the companies may even give you more of the holdings, and say, who are they holding? Maybe that's who I should be spending my money with, because spending your money where you're investing seems to be good for your investments. Maybe even telling your friends makes it good for your investments. So just think Visa the next time, if you got one, when you swipe, think of the other Visa I just gave you.
I love that. I'm gonna have to use that again. I mean, when we think about all the ways that we either have power, grow our power, or show our power versus giving it away, those are all the ways: voting, the way that you invest, where you spend your money, and then how you advocate. So it's so powerful. Our dollar has so much power, and unfortunately, we're giving it away to other people. So we know that we can take that power back. And this is a great opportunity to do it. I want to thank you so much, James, for being with us today. As you see, his contact information is here on the screen. So reach out to him, go through the questions that you may have, talk about a potential portfolio as you look to really align your investment dollars with how you want the world to be as well. So until next time, please be sure to join us next week. I want to thank you all for being with us for another Great Money Monday, and have a wonderful night.